Hello, I'm Mike Shear. I'm the Customer Service Manager with AgRisk Solutions. With the recent drop we have seen in commodity prices, we have already had many of our clients asking us about the potential for revenue claims as we enter fall harvest. Whenever we're in this kind of a situation, it's always a very complex and complicated, confusing process. So I thought I'd sit down and put together a quick video that just kind of explains how revenue claims work and how you might prepare for them for your farm operation and determine if it's something that might affect you for this season. So first off, I just want to mention that everything that I am going to talk about here pertains to the revenue protection type of crop insurance policy. So if you do not have that type of policy, what I'm going to talk about here really doesn't pertain to you. So it'd be important to talk to your agent and find out if that is the type of coverage you have. With that in mind, I want to start this by defining a couple of very important terms that are used to explain the revenue protection coverage. That is the base price and the harvest price. So first we're going to look at corn and the base price. So the base price for corn is determined by taking the February average of the December Chicago Board of Trade corn futures contract. So during that month of February of 2013, they looked at the closing price every day of that December CBOT corn contract. At the end of the month, they took an average of those closing prices, and that became our base price. So for 2013, that base price was $5.65. Next is the harvest price. So this will be calculated by taking the October average of the December Chicago Board of Trade corn futures contract. So that will happen this fall, October of 2013. They'll do the same thing during that month. They'll look at the closing prices of that contract. At the end of the month, they'll average them together, and that will be our harvest price. We obviously do not know at this time what that is. Look at the same thing for soybeans. The base price is calculated the exact same way at the exact same time. During the month of February, they'll take the average of the November Chicago Board of Trade soybean futures contract. And for 2013, that base price came in at $12.87 per bushel. The harvest price will be calculated as the October average of the November Chicago Board of Trade soybean futures contract. So again, we do not know at this point what that price will be. This shows a chart of the 2013 December Chicago Board of Trade corn futures. And this is as of August the 6th, 2013. So you can see here, right in this area, is the month of February. That's where we averaged our base price and where we came up with the $5.65 base price. Also, as you can see, throughout the spring and early summer, prices held fairly constant. However, on about July 1st, we've started a pretty strong downward trend, and we're continuing on to that. So somewhere out here in October, we will calculate our harvest price. Exactly where that will end up is anybody's guess at this point, but it looks like it will certainly be below the $5.65 base price we established in February. The same story on the November Chicago Board of Trade soybean contract. Again, here is the month of February. Some pretty wide variation during that month, but that's where we got our $12.87 base price. Prices have fluctuated pretty drastically since then, but as of right now are sitting at a point that is significantly lower than our base price. So again, where they will be in November or October, is anyone's guess, but it certainly looks like they will be below, that price will be below our $12.87 base price. So with that, I want to run through some examples of how the revenue protection coverage works in situations like this, where our harvest price comes in lower than the base price. So first, I just want to go through some examples and show how this might work in various scenarios. So this is a corn example. We are going to use an approved yield or an average yield on a unit of 120 bushel per acre. We're going to look at a coverage level of 75% and using our base price of $5.65. So in this first example, I'm going to assume that our harvest price comes in at $4.50. So in October, I'm going to assume that average comes in at $4.50. That's slightly below where that futures contract is trading today. And we're going to look at an actual yield of 90 bushel. So essentially, this yield then that I'm looking at, 90 bushel, is our quote-unquote guaranteed yield. If we take our approved yield of 120 times our coverage level, we get a 90 bushel yield. So the way the revenue protection policy works is first we must calculate the guaranteed revenue per acre. And that is done by taking the approved yield times the coverage level times the higher of either the base price or the harvest price, whichever ends up being higher. So in this particular example, we're going to take 120 bushel per acre approved yield times the 75% coverage level times our 5.65 base price, since that is the higher of the two, and we come up with a guaranteed revenue of $508.50 per acre. The next step to calculate if there is a claim, and if so, how much of a claim, is to calculate the harvested revenue. And that is done by taking the actual yield on that unit times the harvest price. So in this example, like we said, we're going to use an actual yield of 90 bushel per acre. We multiply that by a $4.50 harvest price, and we come up with a harvested revenue of $405 per acre. So then to calculate the claim, we simply take the guaranteed revenue minus the harvested revenue, and that's our claim amount on that acre for that particular year. So in this example, a $508.50 guaranteed revenue minus a $405 harvested revenue, we're still left with a $103.50 per acre claim. And this is all due to the fact that our price declined from $5.65 to $4.50. Had that price stayed the same, we would not be looking at a claim in this situation. So this is exactly what people mean when they refer to a revenue claim with revenue protection insurance. So in this example, we're going to look at the same starting point, approved yield of 120, coverage level 75%, and a 5.65 base price. Now we're going to look at a harvest price of 450 and an actual yield of 110. So before we looked at a 90 bushel yield, now we're going to look at 110 bushel average yield. So this yield is really just slightly below our approved or our average yield in this situation. Again, our guaranteed revenue, same as the previous example, approved yield times coverage level times higher the base price or the harvest price. That's going to be the same amount, $508.50 guaranteed revenue. Our actual yield times our harvest price will equal our harvested revenue. So in this case, we take 110 for our yield, $4.50 harvest price, and we get a harvested revenue of $495 per acre. So to calculate our claim in this situation, we take the $508.50 minus $495, and we're looking at a $13.50 claim. So not a huge claim here, but still, due to that price dropping, even though we only had slightly below average yields, we're still looking at a $13.50 per acre claim. Like I said, not a huge deal, but if that's over 1,000 acres of corn, that's $13,500. So it can add up pretty quickly. So our final example, we're going to start with the same situation, but we're going to look at a harvest price of $4.50 and an actual yield of 120 bushels. So an actual yield that is right at our approved or average yield. So guaranteed revenue is calculated the exact same, $508.50 per acre. Our harvested revenue is going to be our 120 bushel average yield times our $4.50 harvest price, gives us a harvested revenue of $540 per acre. To calculate the claim, we take our guarantee, subtract off our harvested revenue, which in this case exceeds the guaranteed revenue, and our claim then is $0. So the point of this is that when the price falls, it increases your likelihood of claim, and it could potentially increase the size of the claim, but it does not guarantee that you will have a claim simply because the harvest price came in lower than the base price. You can still produce enough bushels to offset that situation. Okay, now I'm going to run through one quick example for soybeans. I won't run through three, we'll just run through one because it works essentially the same as the corn. You're just going to be looking at different numbers. So for this example, I'll use an approved yield of 40 bushel, a coverage level of 75%. So we're looking at a guaranteed yield of about 30 bushel per acre, and a base price, our base price was $12.87 per bushel. And we're going to look at an example where the harvest price comes in at $11.50. Again, that's slightly below where that contract is trading today. And we end up with an actual yield of 30 bushel per acre. So our guaranteed revenue, again, approved yield times coverage level times the higher the base price or the harvest price. So it would be 40 bushel per acre. Approved yield times 75% coverage times our $12.87 base price, since that is the higher of the two, gives us about a $386 revenue guarantee. As before, then we have to calculate our harvested revenue, which will be the actual yield times the harvest price. So in this case, our 30 bushel average yield times $11.50 harvest price gives us a harvested revenue of $345 per acre. To calculate the claim, we subtract out those two numbers, $386.10 minus $345 harvested revenue gives us a $41.10 claim per acre. So again, not necessarily a huge claim, but you take that over a few hundred or 1,000 acres and it's a significant amount of money rather quickly. So I hope that helps you to understand how that works. Again, we don't know what our harvest prices will be. These are still projections, just trying to show you what could happen depending on where those come in. Next thing I do want to go through briefly then is how do we go about calculating a trigger yield, and in fact, what even is a trigger yield? So first let's define that. So the trigger yield is the actual yield below which you will have a payable claim. So basically what we're saying here is that if your actual yield is below the trigger yield, you will have a claim. And the trigger yield is calculated based on the base price, the approved yield, the harvest price, and the coverage level. So the way we calculate that then, the formula, is to take your approved yield on the particular unit times your coverage level election times the base price, and then we divide that by whatever the harvest price ends up being, and that will give you your trigger yield. Look at a couple of examples of how you may do that. So an example for 2013 corn, again, approved yield times coverage level times base price divided by the harvest price. So if your approved yield is 120 and your coverage level is 75%, we know our base price is $5.65. Let's say that our harvest price does come in at $4.50. Our trigger yield then is 113 bushel per acre. So what that means, if that scenario plays out, is that if this unit yields at or below 113 bushel per acre, you could be looking at a claim. And it's interesting to note that the original trigger yield here, if prices hadn't dropped, was essentially 90 bushel per acre. So what's happened here is you now have a 25% increase in your trigger yield or your guaranteed yield because the prices dropped between spring and fall. Same type of an example for soybeans. If we have a 40 bushel approved yield, 75% coverage, and a base price of $12.87, if our harvest price comes in at $11.50, your trigger yield will equal 33.5 bushel per acre. So if, again, like I said, at this point we're projecting that harvest price, if it comes in lower than $11.50, your trigger yield will actually be much higher than 33.5. If it comes in higher than $11.50, that will lower that trigger yield. And in this situation, the original trigger yield was 30 bushel per acre, 40 times 75%. So this would be a 12% increase in your guaranteed yield or your trigger yield. So that helps you at the end of the season to look at each unit and determine what yield you would have to fall below to have a payable claim. Finally, I want to talk briefly about preparing for revenue claims. Revenue claim situations are interesting in that you may not know until after November 1st, when we have finalized these harvest prices, whether or not your yields actually qualify you for a claim. At that point, you may hopefully have harvest completed. Most situations like last year, the last couple of years in some areas, we're fully prepared for claims as we enter harvest. This is a little different ballgame. So with that in mind, I want to give just a few pointers as we move into harvest and how to prepare for this. First and foremost is to notify your service rep prior to destroying any crops other than harvesting them for grain. So if you are going to chop any corn for silage, if you're going to bale any corn, if you're going to bale any soybeans, abandon any crops that won't be harvested for grain, you must notify your service rep prior to doing that. Next would be to conduct harvest assuming that you will have a claim. So what does that mean? Well, mainly keeping proper production records. Things like do not commingle production from multiple units in a grain bin without keeping proper records. Again, talk to your service rep to get more details on what those records need to be. Do not commingle production from multiple units in a conveyance, what we call a conveyance. That would be a truck, wagon, anything like that that is going into town or into the grain bin at all. Do not commingle production from multiple units into one truckload that cannot be separated out, or that will be very difficult at claim time. And again, talk to your service rep prior to harvest. If you think you may have yields that are borderline, try to find out what your projected trigger yields are, see how close you might be to that so that you can formulate a plan on how to properly conduct harvest to make sure you're prepared for potential revenue claims. So with that, I would encourage you to contact us if you have any questions about this issue. We'd be more than happy to help. You can also find us on Facebook by searching for Ag Risk Solutions, and you can follow us on Twitter at Ag Risk Solutions. I want to thank you for your time, taking your time to watch this video. I hope it's helpful. I hope it's educational, and we look forward to visiting with you down the road. Thank you.